All right, so a brand new investment opportunity is about to hit the public market. And believe me, it involves some seriously impressive real estate. Today, we're diving deep into the UI Boustead REIT IPO. We've gone through the official prospectus, pulled out all the key details, and we're going to break down exactly what you, as a potential investor, really need to know. Let's get into it. You know when you drive past one of those super sleek corporate headquarters or a massive logistics hub and think, wow, I wonder what it would be like to actually own that? Well, that's pretty much the opportunity we're talking about today. And we're not talking about just any old buildings here. On the left, you're looking at the stunning Asia headquarters for the pharmaceutical giant GSK. And on the right, that's the Southeast Asia headquarters for the massive global gaming brand Razer. These are just two of the star properties in this initial portfolio. So you might be asking, how does a regular person even get a slice of properties like these? Well, it's through something called a REIT, which stands for Real Estate Investment Trust. Honestly, the easiest way to get your head around it is to think of it like a mutual fund. But instead of buying a basket of different stocks, you're buying a share in a whole portfolio of buildings that generate income. So here's our game plan. First, we'll cover the basics of this new IPO. Then, we're going to look at the bull case, all the reasons you might get excited. After that, we'll flip the coin and dig into the bear case, the risks you have to be aware of. And finally, we'll wrap it all up with the investor's bottom line. All right. Let's peel back that first layer and get into the nitty-gritty of this offering. So what is the UI Boustead REIT exactly? Well, it's focused on the kinds of buildings that are basically the backbone of our modern economy. We're talking logistics centers, high-tech industrial parks, and business spaces. Geographically, its initial portfolio is all in two major Asian powerhouse economies, Singapore and Japan. And the company is planning to list on the stock exchange with a starting price of 88 Singapore cents per unit. Okay, with the basics out of the way, let's move on to the exciting part. How does the prospectus make the case for why this is a fantastic investment? What are the big arguments for being optimistic? Now, here's the headline number that's got everybody's attention, 7.8%. That's the projected distribution yield for the year 2027. In simple terms, that's the annual payout the REIT expects to give back to its investors based on its price. And just to put that into perspective, that is a very attractive number compared to a lot of other income-focused investments out there. It's really the main reason people flock to REITs, for that potential steady stream of income. You know, behind every REIT, there's a parent company that puts it all together, called a sponsor. In this case, it's a company called UIB, and their track record is a huge part of the bull case. They've got almost half a century of operating history. They manage a whopping $4 billion in assets, and this is key. They have a pipeline of more properties ready to go, which could be sold to the REIT down the line. That gives a really clear roadmap for future growth. This right here illustrates another core strength, the tenants. See, a REIT's income is the rent it collects, right? So the quality of who's paying that rent is absolutely crucial. And here we can see a history of long-term relationships with what we call blue-chip clients. Think super stable, reputable companies like Amovid and Nippon Express. Getting that kind of repeat business from global giants, that's a huge vote of confidence and a strong signal of reliable income. It's exactly what investors want to see. And finally, the bull case argues that this REIT is sitting in the perfect spot to ride some of the biggest economic waves happening right now. The crazy growth of e-commerce, that needs massive logistics centers. The huge push towards digitalization, that means more data centers and high-tech spaces. And with companies all over the world rethinking their supply chains, demand for modern industrial properties in Asia is just booming. This portfolio is built to serve those exact trends. Okay, that all sounds pretty great, but any smart investor knows you have to look at both sides of the story. So let's pivot to the bear case and take a hard look at the potential risks, which, to their credit, are also laid out in the prospectus. Every single prospectus has a section on risk factors, and honestly, it's probably the most important part of the whole document. So what does the fine print tell us about the potential headwinds this REIT could face? So the prospectus points out several big ones. First, this REIT is definitely vulnerable to market downturns. If the economies in Singapore or Japan hit a rough patch, demand for industrial space could drop. Second, there's what's called concentration risk. Having all your eggs in one basket, in this case, one real estate sector in one region, is great when things are booming, but it can really hurt if that specific market takes a dive. It also mentions that some of the properties aren't fully leased yet, which could affect revenues. And finally, there's a risk that comes with real estate itself, illiquidity. And that point is so important, it's worth seeing the direct quote from the document.
See, unlike a stock that you can sell in seconds with a click, you just can't sell a giant warehouse overnight. This illiquidity means that if the REIT ever needed to sell a property in a hurry, it might have to take a lower price, and that could directly impact the value for investors.
And let's just circle back to that really attractive 7.8% yield for a second. It is so important to remember that this number is a projection. It's a forecast, an educated guess based on a whole bunch of assumptions. The prospectus is very, very clear that these are not guarantees. If occupancy rates slip, or if tenants can't pay their rent, that projected yield could absolutely change. So we've laid out the arguments for and the arguments against. Now let's bring it all together and figure out the investor's bottom line. So on one hand, the bull case is pretty compelling. You've got an attractive projected income stream, the backing of a really strong and experienced sponsor, a portfolio full of high-quality properties with reliable tenants, and it's all aligned with major economic growth trends. But on the other hand, the bear case reminds us of the real risks. It's vulnerable to economic cycles. All that risk is concentrated in a specific region, real estate is naturally illiquid, and those projections, well, they're just projections. At the end of the day, the prospectus really presents a classic investment dilemma. Do you see a great opportunity here to lock in a strong yield and tap into some major growth trends? Or do you see too much risk packed into a market that could change? We've laid out the facts as presented in the source document. The final decision, of course, is yours. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.